All right, next question comes from Chuck. I am 61 years old, retired, and receiving a pension from both the federal government and the military. My wife and I have significant amounts in IRAs, a 401k, and the federal thrift savings plan. We also own commercial real estate in San Francisco and an annuity that pays me until I turn 69 and a half, just in time for Social Security, which will be twice the amount of the annuity. The income from the pensions, real estate, and annuity is enough to make our living expenses. My question is, when determining how to allocate our portfolio between stocks and bonds, can we consider the pension as equivalent to a very safe bond or long-term annuity? If so, should we feel relatively safe allocating everything in our IRAs, TSP, 401k, and brokerage account to stocks?
Chuck, I appreciate the question. I appreciate your military service, and it sounds like you've put yourself and your family into a really great position. So when you've got enough income coming in from essentially guaranteed sources or sources that are very stable, you can really choose to treat the investments however you'd like. Now, I don't think of a pension identical to a bond in the sense that you can't rebalance out of it.
Right.
So if you thought of yourself as being the kind of guy that would have had a 60-40 portfolio or even an 80-20, meaning 80% stocks, 20% bonds, that pension isn't a replacement for the bond, because if the market has a crash, you can't sell the pension and buy more stocks. So you've lost the ability to rebalance. But in terms of the amount of risk and volatility that you can accept, it's really up to your own stomach acid. Because at this point, it doesn't sound like you're relying on a distribution from the portfolio assets to support your lifestyle. So at that point, it really becomes a determination of how comfortable are you with risk? What are your goals in terms of growth on those assets? And if you want to be all in stocks, I think you can afford to be.
Yeah, I would say the same thing. Now, obviously, his situation is that he has a very secure pension, federal government, military. He's going to be fine. I would just say anyone else out there, you want to make sure that you have a safe pension before you go all in on that and have everything else in the stock market.
Yeah, the way I think about it is we're going to look at your portfolio and say, how much do we need to take from the portfolio on an annual basis to support your lifestyle? And so for some people, if they don't have any pension assets and it's purely Social Security, for example, we might be needing to take that 4 or 5% withdrawal rate. And so the amount that they're going to need to protect so that if there's a market downturn is going to be at least 3 to 5 years of that amount, right? So 25% bond allocation might mean that you can go through a 4 or 5 year drought in the stock market. The less that you're relying on the portfolio, the more you've got pension income kind of covering those needs, you can be a little bit more flexible with how aggressive you get.
Yeah, and Chuck, if you're looking for someone else who agrees with you, and this actually touches on Jonathan's question about bonds, the Globe and Mail recently interviewed Harry Markowitz, who is the Nobel Prize-winning father of modern portfolio theory. He's almost 92 years old, and they asked him, how are you investing these days? And he said, I own very few bonds because I got my teacher's pension, I've got my Social Security, and frankly, I have enough in the stock market so that even if it drops, I still have plenty of money. So he has very little in bonds, and he's not going to be interested in bonds until they get to at least 4%. The other aspect I would add about that is that he's almost 92, and he's still working. He's still writing books. He's still consulting. He's still on the faculty at UC San Diego. So that's a whole other aspect for him. He's got his situation taken care of.
That's always my favorite, Buffett fact, right? People want to invest like Warren Buffett, and I'm like, you realize he's in his 80s and still working. That's the first thing to growing your wealth by a lot from where it is,
true.
is that you don't stop at 65.
Yeah.